Today, inflation fears to the fore. The DFA Daily to the 10th of November 2021. Hello again, it's Martin North from Digital Finance Analytics, working on this post covering finance and property news with a distinctively Australian flavour. In today's show, we check in on US markets as new economic data suggests to some that inflation may be peaking. Then we look at the NAB results, where margin compression is probably the main story. Then we'll consider how blockchain may impact property. And finally, what's expected from today's Chinese data on inflation, which does appear to be running hot. The S&P 500 fell on Tuesday. The S&P 500 fell on Tuesday, paced by a Tesla-led slump in consumer discretionary stocks and weakness in financials, as US Treasury yields slipped following signs of slowing inflation. The Dow Jones Industrial Average was down 0.3% to 36,320, while the S&P 500 ended down 0.4% to 4,685, marking its first decline in 9 sessions and narrowly missing its longest string of record closes, 9 straight all-time highs since 1955. On Monday, the S&P 500 marked its longest string of record closes with 8 straight since 1997. And the Nasdaq closed lower, down 0.6% to 15,887 for the first time in 12 sessions. Tesla fell nearly 11%, adding to its 10% slump from Monday, as investors anticipate that CEO Elon Musk will offload 10% of his stake in the electric vehicle maker after followers backed the move in a recent Twitter poll. General Motors and Ford Motors also dragged the sector deeper into the red. Financials are weighed down by weakness in banking stocks amid a fall in US bond yields following signs of slowing producer inflation. Yields for the 10-year Treasury note was 1.438, and that's down from 1.496 on Monday. Amongst financials, Lincoln National, Prudential Financial and Wells Fargo were all down more than 1%. In US economic data, the October Producer Price Index, or wholesale inflation, rose 0.5% in September, missing expectations for a 0.6% gain, with inflation over the past 12 months flat at 8.6%, but that's still marking the highest level since the index was reconfigured in 2009 and is likely one of the highest readings since the early 1980s. But core PPI inflation fell short of estimates. Core goods inflation looks to be peaking. This is not definitive yet, but it is encouraging at the margin, said Pantheon Macroeconomics. Industrials outperformed the broader market following a 2% climb in General Electric after the GE conglomerate outlined plans to split into 3 businesses. GE will split its businesses into health, care, energy and aviation, but would eventually focus on the latter amid plans to sell healthcare and energy in 2023 and 2024, respectively. On the earnings front was pretty mixed, actually, with PayPal down 12% after the payments company reported mixed third-quarter results with a miss on revenue estimates, while guidance also disappointed. The quarterly results drew a slew of negative reactions from Wall Street, with analysts like Morgan Stanley cutting its price target on the stock to $265 from $340, but still kept their overweight rating. PayPal is being adversely impacted from hangover impacts of the pandemic, which is creating a bigger drag on growth than we had previously anticipated, negatively impacting our 2022 estimates, said Morgan Stanley. And Palantir Technologies slumped more than 9%, despite reporting third-quarter results that topped expectations. And Roblox, meanwhile, was one of the standout performers, going up 35% after reporting better than expected Q3 results, underpinned by stronger user activity despite the easing of pandemic restrictions and back-to-school seasonality. And in other news, speculation whether Jerome Powell will retain his position as Federal Reserve Chairman intensified following a Bloomberg report that President Joe Biden had interviewed Fed Governor Lael Brainard as a possible candidate for the top job. So keep an eye on that. Now, back here in Australia, NAB managed to grow its home loan book over the 2021 financial year, but margin pressure is expected to continue into the coming months. They posted the results for the year to the 30th September on Tuesday, and they reported a 61% year-on-year surge in net profits to $6.3 billion. The group's gross loans and advances grew by 5.9% to a total of $621.1 billion for the financial year 21, with housing loans accounting for $360 billion, up 5.3% year over year. In the personal banking division, housing lending grew by 2.5% year over year to $212 billion. And digital subsidiaries UBank and 86400, on the other hand, contributed to loans totaling $9.1 billion, up by 10% from September 2020. As a result of volume growth in home lending, cash earnings for personal banking were up by 14.4% to $1.6 billion. While NAB reported growth in mortgages and profitability, its net interest margin was squeezed by competition and a product mix shift towards more fixed-rate lending, with its declining by 6 basis points to 1.71%. Excluding large notable items of $49 million in 2020, net interest income slipped by 1%, or $133 million to $13.7 billion. The bank expects competitive pressures for housing lending margins to continue into next year. There is substantial competition across the market in which the group operates, the annual financial report stated when reflecting on NAB's risk profile. The group faces competition from established financial services providers, as well as new market entrants, including foreign banks and non-bank competitors such as fintechs and digital platforms, some of which have lower costs and/or operating and business models or products that differ or are more competitive than the group. Intense competition also increases the risk of a price war, especially in commoditized lines of business, where the players with the lowest unit cost may win share and industry profit pools may erode. The bank's broker share in home loans also grew over the year. Around 41.8% of NAB's home loan portfolio had been sourced through brokers. That's a rise from 37.8% in September 2020. The proportion of home loans from the direct channel had shrunk from 62.2% over the year to 58.2%. And NAB also reported that it has continued to roll out the Simple Home Loan system, which now processes around 80% of its proprietary applications. The platform reportedly returns home loan approvals within an hour for 30% of applications, or a day for 60%, and around 80% reportedly see an outcome within 5 days. The bank had flagged the platform will be rolled out to brokers next year alongside a new credit decision engine for the channel. In addition to digitalisation, the bank has moved to simplify and streamline its home lending policies. And NAB's CEO Ross McEwan also said that another increase in the loan buffer for borrowers by the prudential regulator will be the most effective way of heading off a New Zealand-style rising house price crisis, with fixed interest rates rises by banks unlikely to do the job. We cannot see another 20% house price growth over the next 12 months. We cannot afford to have that happen in the Australian marketplace, he said on Tuesday. House prices in Sydney have soared 25% over the past year due to the record low cash rate. The bank boss backed the Reserve Bank of Australia's decision to hold off hiking the cash rate until economic conditions improved, saying higher funding costs for the bank in offshore markets were already creeping in, forcing them to lift fixed rates on mortgage products. But he recognised these may not slow the market down enough and suggested the fairest and most effective way to apply the brakes with more force would be for the Australian Prudential Regulatory Authority to double the rise in the serviceability buffer. It was raised by 50 basis points to 3% on October 31, restricting the amount banks can lend to customers by about 5% on average. They could always move that again, McEwan said. My view and discussions with the regulator have been that it is the simplest way to have an impact. And McEwen and the NAB board have tried to balance the need to support fossil fuel producers through the energy transition with the need to keep its commitment to achieve net zero by 2050. The centrepiece of the new policy is a pledge to cap oil and gas loans at $2.4 billion until 2026, after which its lending to those sectors will shrink. NAB is currently lending about $3.2 billion until 2026, after which its lending to those sectors will shrink. NAB is currently lending around $2.9 billion to those sectors, so climate activists are immediately seized on the prospect that this could rise over the next 5 years, particularly as loans to existing projects roll off. McEwen stressed that NAB is a relatively small lender to oil and gas, and 70% of its lending to energy, which is more than $5 billion, goes to renewables. But he said there remains a need to help energy firms change their businesses. Oh, and just in passing on NAB, it's worth noting that their provisions were lower, so one of the reasons why their profitability was so much better than last year was because of a reversal of provisions made earlier, which is an accounting fix, not a real business fix. But of course, again, that hardly ever gets reported. Now next, buying a home with Bitcoin and other cryptocurrencies could revolutionize how brokers interact with customers in the near future. Blockchain, the tech that underpins cryptocurrencies, could be set to reshape how brokers, lenders and customers interact in the property market in Australia, with open source software representing the next stage of online interaction. Research has seen property transaction times reduce from 3 months to 3 weeks in the UK, blockchain trials, showing the potential for transparent tech to speed up and decentralize processes. Blockchain is the next evolution of the internet, explained Lachlan Freeney, CEO of Labris, one of Australia's leading blockchain developers. It's an open infrastructure network where you can build applications that could be useful to the property and mortgage broking industry, but also just generally. It's thousands of computers that run around the world. An application today that runs on the internet is hosted on a single server that sits at Google or Amazon somewhere. That's the way the whole internet works today. What blockchain is, and what the whole internet is going to move to, is that instead of hosting it in a single server somewhere, it'll be hosted on distributed networks so that your application exists and is duplicated on thousands of servers around the world. And when it runs and your users use it, it's guaranteed to run every time. It's immutable. You can't change it. You can't hack it. It's a better way of storing data, running applications and communicating both person to person and computer to computer over the internet. The potential for blockchain to disrupt the property market in Australia comes from several different angles, he said. There's a few different angles that organisations in the blockchain space have tried to bring to the property space. We're still very early and we're still trying to work out the best use cases. One of the things that has been focused on to date is tokenisation of real estate assets. In the blockchain space, you can tokenise anything, which means creating a digital representation of a digital asset. You could purchase a property and put it in a trust and then issue tokens against it on a blockchain system. If you issue thousands of tokens, you could break down the investment to a few dollars per person, which would allow many people to get exposure to real estate assets. There's a big difference between what is possible technically and what is possible within existing regulatory frameworks. So these are the areas that we're still trying to navigate. But in that space, the idea is that there is new tech that allows us to fractionalize assets down to small units, and we just need to work out how to make them available within the existing regulatory framework. The benefit would be that you could get investors with small amounts of capital into investing in markets where traditionally there are fairly high barriers to entry. And buying a property using Bitcoin and other cryptocurrencies could also be another way in which the blockchain ecosystem intersects with the housing market. Another use case is, instead of trying to use blockchain to represent the property itself, you could go on the flip side and use blockchain as the currency used to purchase the property. That could be allowing people to buy property in Bitcoin or other cryptocurrencies or via stablecoin, which are like digital versions of the Australian dollar. There's various reasons why you might want to do that. The price of Bitcoin is quite high at the moment, almost 100,000 Aussie dollars per coin. So there is a lot of cashed up Bitcoiners out there looking to purchase property, and it's easier for them if the seller is willing to take purchases in Bitcoin rather than them having to cash it out first. Properties are now starting to sell in Bitcoin and other cryptocurrencies, and that can even be taken as a marketing tactic to stand out. Another thing you can do when you use crypto is to use smart contracts, which are developed on the blockchain-based escrow systems, which can help to save costs around the sale of the property. Instead of using a traditional provider, you can create a smart contract on the blockchain that takes in the currency and locks it up in a smart contract. You could put the deposit in, and when other things fall into place, that money can get released to the seller based on conditions. There's plenty that can be done there using blockchain-based currencies. A third big area is what we call DeFi or decentralized finance. That's when you take out collateralized loans on the blockchain. One of the biggest blockchain lending protocols is called Compound. They're experimenting with using real-world property as collateral on their platform. If you can verify that you own a property in the real world with Compound, they can use it as collateral, and you can take out a loan in crypto or stable coins against the value of it. That's not fully available to the public yet, but it's an exciting application in the space where real-world property is used on the blockchain. But I would just say we should be very cautious here, because the process of financialization of property is already pretty extreme, and actually now atomizing property and allowing people to hold assets on the blockchain seems to me to be just another reason which will actually put prices up even more and make property less affordable. So you should be cautious. I actually think that the idea of settling via blockchain and using smart contracts via blockchain could indeed make property settlements much more efficient. But of course, there are also risks, and some of those risks relate to fraud. So this is a space to watch rather than to pile in straight away, in my view. And finally, China will report October inflation data today, and this is one to watch. Prices that Chinese companies charge for their output likely rose at the fastest pace in more than 2 decades last month, driven by the continued commodity boom and an energy crunch, coupled with a resurgence of COVID and bad weather. The producer price index is expected to have climbed 12.3% last month from a year earlier, according to a median estimate in a Bloomberg survey of economists. That will be the fastest pace since late 1995. Producer prices in China have been rising rapidly in the past few months, first due to the global commodity price rally, and then output curbs caused by a power crunch nationwide. While the impact of higher PPI on global inflation is small, faster inflation is likely to worsen the situation for domestic businesses, especially smaller ones, which were already facing higher costs and weak domestic demand. Premier Li Keqiang recently said the government needs to address the problems faced by small and medium-sized companies, including commodity-driven costs, and further price rises may add to calls for policymakers to step up to support the economy, to step up support as the economy slows. Consumer inflation, which has stayed relatively low due to falling pork prices, likely accelerated to 1.4% in October, and a recent spike in vegetable prices likely offset some of the deflationary effect of falling pork prices and pushing food and headline consumer inflation higher in the month. The expected pickup in CPI suggests that businesses have become more willing to pass on the higher cost to customers despite weak demand at home. And several food companies have already announced price hikes of up to 15%, including Hexen Food, Enjoy Food, and JJ Food, due to rising costs for raw materials. So standing back, the inflation discussion continues, and we're very interesting to see whether in fact inflation in China is stronger and how that feeds through the supply chains, because of course many of the raw materials from China find their way into goods and services across the world. As well as the domestic momentum question in China, the international pressures on inflation will be significant, I think, and therefore it is one to watch. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.